If you want to understand how expensive or cheap assets are over long cycles, it can be insightful to remove the dollar component. Pricing assets in gold instead of dollars gives an important long term perspective. Take U.S. housing. Today, a median American home costs roughly 100 to 120 ounces of gold. That is a remarkably low number compared to major historical peaks. In 2000, at the height of the tech boom, it took roughly 400 plus ounces of gold to buy a median home. By 2002, that number pushed towards 600 to 700 ounces in some measurements. Even as recently as the mid 2000s housing bubble, the ratio was several multiples higher than it is today. The long term average over the past few decades is often cited around 250 to 300 ounces. By comparison, the 1980 extreme, when gold spiked during stagflation, she saw homes fall to roughly 85 to 100 ounces. Today's reading is much closer to that 1980 extreme than to the 2000 to 2006 housing bubble highs. In gold terms, real estate is nowhere near historically expensive levels. The same story appears in equities. If you price the S&P 500 in gold, the current ratio is roughly 1.4 to 1.7 ounces of gold per unit of the index. That is low by historical standards. At the peak of the dot-com bubble in 2000, the ratio reached approximately 5.5, meaning stocks were extremely expensive relative to gold. During the 2008 to 2009 financial crisis, it dropped to around zero point 0.6, reflecting a period when gold significantly outperformed equities. In the late 1970s, during the inflation surge, the ratio fell even further to roughly 0.17. Over long stretches of the 1980s and 1990s bull market, the ratio remained far above today's levels. In other words, compared to many prior decades, equities priced in gold are relatively compressed. What this tells us is not that housing or stocks are cheap in dollar terms. In dollars, both may look expensive to many people, but relative to gold, which has had a powerful multi year run, both real estate and equities sit toward the lower end of their historical valuation ranges. Gold has gained purchasing power against both asset classes. Historically, these extreme readings tend to occur near major cyclical turning points. When the house to gold ratio is very high, housing has often underperformed gold in subsequent years. When it is very low, housing has often regained ground in nominal terms over time. The same cyclicality has appeared in the stock to gold ratio across decades. None of this guarantees what happens next. Ratios can stay stretched for years. But from a long term purchasing power perspective, we are in a period where gold is historically strong relative to both U.S. housing and large cap equities. That is a very different narrative than simply saying home prices are high or the stock market is expensive. Context matters, and measured in gold, the landscape looks very different.